October 29, 1929, Black Tuesday. The stock market loses 12% of its value in a single day. Within weeks, $30 billion evaporates. That's $500 billion in today's money. Gone. The scale of the collapse was not just financial, it was existential. This wasn't a dip, it was the entire foundation of the Roaring Twenties crumbling into dust. The nation was immediately plunged into a deep cycle of deflation, where prices fell so fast that businesses couldn't make a profit, leading to massive layoffs and a crippling halt to commerce. Deflation is a silent killer in a debt-based economy, as it makes the real value of outstanding loans increase, effectively tightening the financial noose on debtors and further discouraging any new investment. By 1933, 25% of Americans are unemployed. Families stand in breadlines for hours just to eat. Banks collapse, businesses shutter. The American dream dies for millions. But 5 men saw something different. Where others saw disaster, they saw opportunity. By 1935, they'd built fortunes worth billions in today's money. This is how they did it. To understand how these men got rich, you need to understand just how bad things got. Between 1929 and 1932, the Dow Jones Industrial Average fell 89%. Nearly 10,000 banks failed, wiping out the life savings of ordinary Americans. Industrial production dropped by half. Construction virtually stopped. Unemployment hit 25%. 1 in 4 workers had no job. Compounding the financial crisis was an agricultural one, as crop prices plummeted, driving millions of farmers off their land and further deepening the crisis in rural America. This was an economic environment defined not just by scarcity, but by absolute terror. Families lost their homes. Shanty towns called Hoovervilles spring up in every major city. People literally starved to death in the richest country on earth. The collective psychological state was one of profound shock. The speculative mindset of the 1920s, which saw everyone from housewives to chauffeurs dabbling in the market, was replaced overnight by a paralyzing, desperate fear. This massive, sudden shift from greed to fear created a temporary, profound distortion in the value of nearly every tradable asset in the United States. But here's the paradox nobody talks about. While the average American suffered, wealth concentration actually increased during the Depression. The rich got richer. Not by luck, by strategy. These 5 men understood something fundamental about economic crashes. When everyone is selling in panic, assets become cheap. When everyone needs cash desperately, those who have it hold all the power. When fear dominates markets, contrarian thinking pays off. The secret wasn't magic. It was holding liquid capital and having the emotional fortitude to execute a disciplined strategy while the entire financial world screamed "sell" in unison. This required a rare psychological resilience, the ability to act against the tidal wave of public opinion and economic despair. The essential mechanism at play was credit contraction. As banks failed, the money supply shrank, making dollars incredibly scarce and thus incredibly valuable to those who possessed them. Let me show you exactly how they did it. Joseph P. Kennedy, Sr., the father of President John F. Kennedy. Before the crash, he was worth about $4 million, roughly $60 million in today's money. By 1935, his fortune had grown to somewhere between $150 and $180 million. That's $4.3 billion adjusted for inflation. How did he do it? Kennedy saw the crash coming. The famous, often repeated anecdote is more than just a colorful story. It speaks to his sharp, cynical understanding of market psychology. The story goes that one morning in 1929, he was getting his shoes shined. The shoeshine boy started giving him stock tips, excitedly listing the latest sure thing speculative play. Kennedy realized something terrifying. When shoeshine boys, people with no specialized knowledge and traditionally outside the investment class, are giving stock advice, it signifies that maximum euphoria has been reached. The market has gone insane, and it means the supply of new, naive buyers is exhausted. The bubble is about to burst. He immediately called his brokers and gave them one instruction: sell everything, all of it, now. He reportedly threatened to fire anyone who hesitated. Within weeks, Kennedy had liquidated his entire stock portfolio. He moved his capital into cash and short-term, high-quality bonds, prioritizing liquidity and capital preservation above all else. Then, he did something even smarter. Taking advantage of the coming panic he had foreseen, he went short. Short selling means betting that stock prices will fall. You borrow shares, sell them at the current high price, then buy them back later at a lower price and pocket the difference. It's incredibly risky because losses are theoretically infinite if the stock rises. But Kennedy was convinced the market would collapse. His strategy wasn't just shorting, it was a targeted, overwhelming bet. For example, if he borrowed 10,000 shares of a $100 stock and sold them, he immediately received $1 million. When the stock plunged to $10, he bought those 10,000 shares back for only $100,000, netting a profit of $900,000 before fees. He was right. When Black Tuesday hit on October 29, 1929, Kennedy made a fortune as stocks plummeted. While millions of Americans watched their wealth evaporate, Kennedy's wealth multiplied, his short positions paying off handsomely as the Dow plunged day after day. But he didn't stop there. After the crash, Kennedy had something more valuable than gold: cash, liquid capital. While everyone else was desperate for money, Kennedy could buy assets at pennies on the dollar. He wasn't just buying stocks, he was buying hard assets that generated income. He bought commercial real estate across America. His most famous purchase was the Chicago Merchandise Mart, one of the largest buildings in the world at the time, which was financially distressed. He bought it at a fire sale price during the Depression, securing ownership of a physical asset with reliable, long-term lease income, a classic Depression-era bargain. The mart was an immense, self-contained commercial ecosystem, and buying it ensured Kennedy a steady, defensible income stream throughout the lean years. It would become one of the most valuable properties in America. Kennedy also profited from Prohibition. Recognizing the inevitable repeal of the Volstead Act, he began quietly securing import licenses for high-quality European liquor brands such as Dewar's and Gordon's Gin. When Prohibition ended in 1933, he was perfectly positioned with product and legal access, making millions more as Americans celebrated by drinking legally again. Was it insider trading? Probably. Kennedy had connections high in government and finance. There were rumors he had advanced knowledge of market movements, especially concerning regulatory actions, but nothing was ever proven. In the 1930s, insider trading wasn't even illegal. Kennedy's strategy was simple: exit before the crash, profit from the fall, buy assets cheap, hold cash when everyone else is desperate. By the mid-1930s, Joseph P. Kennedy Sr. was one of the richest men in America. His fortune would fund a political dynasty that would produce a president, senators, and shape American politics for generations. J.P. Getty, the oil baron who would become one of the richest men in history, Getty understood one fundamental truth about wealth creation. The best time to buy is when blood is in the streets. When everyone else is panicking and selling, that's when you buy. He recognized that the panic was causing a catastrophic decoupling of a company's stock price from its underlying asset value. A strong company might be selling for a fraction of the physical assets, the oil fields, the refineries, the pipelines, It owned this gap between intrinsic value and market price was Getty's personal gold mine. In 1932, with the Depression in full swing and fear peaking, Getty started buying oil company stocks. Not just any stocks, he targeted companies with dominant market positions that were trading at absurdly low prices because of panic selling. His main target was Tidewater Oil. Before the crash, Tidewater was a major oil company with extensive proven oil reserves and significant infrastructure, including vast retail distribution networks and refineries. After the crash, its stock price collapsed, falling from over $50 per share down to near $2. Getty bought shares around $2.12 per share. The company was worth much more. Its physical assets alone justified a much higher price, but nobody had cash to buy, and everyone was selling in fear. This was pure value investing, driven by crisis. Getty also acquired Pacific Western Oil Corporation and Skelly Oil during this period, recognizing that the depressed prices provided a unique opportunity for hostile takeovers or large-scale accumulation of control. He bought controlling interests in multiple oil companies while they were on sale, securing access to crucial new drilling sites in Oklahoma, Texas, and California for rock-bottom prices. His strategy was patient, relentless, and focused on controlling physical means of production. He didn't try to flip these investments quickly. His aim was not a short-term trade, but a long-term corporate consolidation. He held them. He consolidated them. He built an empire while everyone else was trying to survive. By 1951, Getty had gained numerical control of Tidewater Oil, a decade and a half after he started buying. In 1967, he merged all his oil holdings, including Tidewater, into Getty Oil. The company he built during the Depression would make him a billionaire. Getty had a famous quote that summarized his Depression-era masterstroke: "Buy when everyone else is selling, and hold until everyone else is buying." The Great Depression was the ultimate test of that philosophy, and it worked spectacularly well. The key to Getty's success was having capital when nobody else did. He'd inherited wealth from his father's oil business, and he ensured that he kept that wealth liquid and ready for action. While that initial wealth wasn't enormous compared to the established titans, it was enough to purchase assets during the Depression when prices were at rock bottom. Getty proved that economic crashes don't destroy wealth in totality. They simply transfer it from the panicked to the patient, from the desperate to the disciplined, from those who sell in fear to those who buy with courage. Howard Hughes, the eccentric billionaire who would later become a recluse. But in the 1930s, he was a young man with inherited wealth and big ambitions, and a penchant for risk-taking and strategic vision. Hughes inherited his father's tool company, Hughes Tool Company, which made specialized drill bits for oil exploration and production. Crucially, the company generated steady cash flow even during the Depression because oil production, while slowed, never stopped completely, and the specialized bits were always needed. That continuous cash flow gave Hughes something critical that his competitors lacked: liquidity and continuous war chest funding. This was the ultimate competitive weapon during a credit crisis, allowing him to operate independently of collapsing banks. During the Depression, Hughes went on a buying spree, focused not on immediate profit but on future dominance. He acquired distressed aviation companies, seeing the immense potential for air travel and defense long before the infrastructure existed. He bought Trans World Airlines, TWA, when it was struggling financially and took control. using it as a vertically integrated platform to also drive his aircraft manufacturing business. He invested heavily in aircraft manufacturing at a time when most people thought the aviation industry was dead, betting correctly that government spending and global travel would eventually require a massive fleet upgrade. This included significant investment in his own Hughes Aircraft Company, securing military contracts just as the world began rearming. Hughes also bought real estate, lots of it, particularly in Southern California and Nevada. Land prices had collapsed as people defaulted on mortgages and construction halted. Hughes bought thousands of acres for pennies on the dollar, effectively betting that population growth and urbanization would resume. His most famous Depression-era purchase was land in Las Vegas. In the 1930s, Las Vegas was nothing, a small, isolated desert town with a few thousand people and limited prospects. Hughes bought vast tracts of land there for almost nothing, primarily for his aviation testing and personal interests, but holding on to it. Decades later, that land would become the core of the Las Vegas Strip. Hughes would build casinos and hotels on land he bought during the Depression. That investment alone would be worth hundreds of millions of dollars. Hughes understood strategic leverage. He used the Depression to position himself in industries that would explode after the massive military and infrastructure buildup of World War II: aviation, entertainment, real estate, and defense contracting. By the time the Depression ended, Hughes had assembled an empire: Hughes Aircraft, TWA, vast real estate holdings, and movie studios, all bought or expanded during America's darkest economic hour. The lesson from Hughes is about vision. He didn't just buy cheap assets. He bought assets in industries he believed would grow massively in the future, securing technological and logistical monopolies years ahead of time. He was right. Jesse Livermore, the greatest stock trader of his generation, and a profound cautionary tale that underscores the difference between making money and keeping money. Livermore predicted the 1929 crash. He saw the same signs Kennedy saw: excessive speculation, margin debt at record levels, euphoria in the markets, all the classic textbook signs of a bubble about to burst. In the months before Black Tuesday, Livermore built massive short positions, showing an almost inhuman degree of conviction. He bet billions in today's money that the market would crash. When it did, Livermore made a fortune. Reports vary, but most historians estimate he made around $100 million from the crash. That's roughly $1.7 billion in today's money. In a single year, he achieved the most incredible financial feat of his era, effectively profiting from the collective ruin of a generation. Livermore became a legend, the man who called the crash, the trader who got rich while America went broke. But here's where the story gets dark. Livermore was a speculator, not an investor. He couldn't stop trading. He was addicted to the markets, the thrill of the massive bet, the high-stakes psychological warfare. After his massive win in 1929, he kept speculating. He made bad bets, attempting to time every minor fluctuation in the market's agonizing journey downward, believing he could replicate his big short again and again. He lost discipline, turning his $100 million cash pile into a fuel source for poor decisions. Furthermore, his personal life became chaotic, marked by instability and expensive divorces, rapidly draining his remaining capital. By 1934, just 5 years after his greatest triumph, Livermore had lost everything. He declared bankruptcy. The $100 million was gone. He spent the rest of his life trying to rebuild. He never did. In 1940, at age 63, he walked into the cloakroom of the Sherry Netherland Hotel in Manhattan and shot himself. His suicide note to his wife read, "My dear Nina, can't help it. Things have been bad with me. I am tired of fighting. Can't carry on any longer. This is the only way out. I am unworthy of your love. I am a failure. I am truly sorry, but this is the only way out for me." Livermore's story teaches a critical lesson that applies as much to market crashes as to life itself. Making money during a crash isn't enough. You have to keep it. You have to know when to stop trading and start investing. You have to diversify and transition your speculative profits into defensive long-term assets. You have to preserve capital, not just accumulate it. Livermore was brilliant at reading markets, but he was terrible at managing wealth. That combination destroyed him. John D. Rockefeller, the richest man in modern history. By 1929, Rockefeller was already in his 90s and had retired from active business. But his fortune not only survived the Depression, it grew, demonstrating the power of structure and conservatism. How? Diversification and discipline. By the time the Depression hit, Rockefeller had diversified his wealth across multiple asset classes: stocks, bonds, real estate, commodities, and critically, robust essential industries like utilities, railroads, and gold. This wide net meant that when one sector, the speculative stock market, collapsed, the rest of his holdings acted as a stabilizing counterbalance. His vast bond holdings, particularly U.S. government bonds, actually increased in real value due to the deflationary environment. When the stock market crashed, Rockefeller didn't panic. He didn't sell everything. He held his quality assets and, utilizing his considerable liquidity, bought more when prices fell. During crashes, only the strong survive. Rockefeller bought shares in companies he knew were fundamentally sound, possessing durable competitive advantages, but were trading at depressed prices because of generalized panic. He bought more Standard Oil shares, his family's foundational asset, broken up into separate companies, more railroad stocks, and more utility companies, betting on the core infrastructure of America that people would rely on regardless of the economic climate. He also moved significant wealth into safe assets, government bonds, gold, and cash. He preserved capital while patiently waiting for value opportunities, ensuring that a temporary economic disaster did not compromise his long-term holdings. But he preserved and grew his wealth steadily, using the chaos to slowly and cheaply consolidate positions in essential, durable American industries. By the time he died in 1937, his fortune was estimated at $1.4 billion. That's roughly $26 billion in today's money. It wasn't just individuals who got rich during the Depression. Some companies thrived by doing the exact opposite of what everyone else did, embodying the same contrarian spirit. Take Procter Gamble. When the Depression hit, most companies slashed their advertising budgets. It made perfect sense from a crisis management perspective. Sales were down, cash was tight, so the logical move was to cut expenses like marketing. Procter & Gamble did the opposite. They increased advertising, seeing the temporary retreat of their competitors as a wide open field. They pioneered radio advertising targeting housewives during the day with serial dramas, often featuring family struggles and domestic themes. These shows became known as soap operas because they were literally sponsored by soap and detergent companies. By 1933, Procter & Gamble was producing 21 different radio programs. They dominated the airwaves while their competitors went silent, establishing unparalleled brand loyalty and market share during the period when consumers were most selective and cost-conscious. By consistently projecting an image of stability and essential reliability, P&G captured customers for life, ensuring their growth continued through the 1930s and beyond. The Great Depression was the ultimate economic sieve, stripping away the speculators and the weak, leaving the disciplined and the patient to rebuild and own the world that emerged from the rubble. Their success was a stark, brutal demonstration of capitalism's iron law. Crises are never just failures. They are the greatest opportunities for wealth transfer.